Welcome everybody to tonight's webinar on Q3, Quarter 3, 2024 Investment Outlook, Investment Strategies for the Year Ahead. This is part of our Investment Outlook webinar series that we hold quarterly. And as in previous webinars, our experts, who I'll introduce in a bit, will first share a comprehensive update on both the global and the macroeconomic environment, and the equities, that's stocks, and the fixed income ecosystem, that's the treasury bonds and treasury bills in Kenya. So you'll get a comprehensive update on what is going on in this ecosystem, what has been happening in the first half of 2024, and therefore we'll then share insights on portfolio management for the quarter ahead. What should you invest in? How should you invest going forward? So it's an excellent session for investors to understand exactly what's happening in the markets, and also to know what we believe is the ideal way to position your portfolio going forward. So we'll also be recording the webinar, but it's best to stay until the end because we want to hear your questions. We'll have a 15-minute session at the end where you'll be able to ask your questions and have them answered by our panelists. So feel free during the webinar to write your questions in the chat, in the Q&A, and we'll definitely address them at the end. And tonight with us, we have our speakers. We have Ronnie Choka. He's the Senior Research Analyst with AIB Axis Africa. He has a lot of experience in the market. He understands it back to front and is excited to share with you what he has today. And we also have Stacey Macau, also a research analyst and expert in the markets with us from AIB Axis Africa. So I encourage everyone to take out your notebook, grab a pen, and enjoy learning what has been going on in the markets and help you position your portfolio, know what to invest in going forward in 2024. So I now have the pleasure to hand over to Stacey and Ronnie. Over to you.
Thank you. Thank you so much, Nyla, and good evening and a warm welcome to all our delightful guests. Thank you so much for tuning in. We are very much excited to present our 2024 Q3 investment outlook. And our theme for this quarter is aiming for the green zone. This is part of our 2024 series with our investment play theme, which was swinging into action. And we aim to give you investment strategies for the year ahead. We endeavored to prepare quarterly updates, quarterly sequels, in line with the overarching theme of the year. We have tracked the developments across the global market and more specifically the Kenyan market to give you, the investor, what we believe are cutting-edge investment implications on how you will tailor your portfolio or how you position your portfolio to land in overall green zone. By green zone, of course, we imply a positive return on your overall investment portfolio. So I will begin by going through the global macro outlook briefly for context, and funnel down the Sub-Saharan Africa landscape before handing over to Stacey, who will take us through the Kenya macro outlook. As a prelude to the equities outlook, we'll then have also an insight or delve into the fixed income space, and we'll conclude with portfolio management implications. After which, as Nyla has directed, we'll open the floor for Q&A. All right, so how was the first half of 2024 like in summary? I think the first theme that has shaped the first half of the year is that we are seeing growing optimism across global markets, despite the effect of legacy shocks from the pandemic, from the rapid tightening of interest rates that we saw, from the elevated inflationary pressures over the past 3 years running, And we are seeing generally global growth continuing to display resilience. The recovery has been gradual but steady. Growth sometimes even surprising on the upside. We are seeing output gaps, which is the difference between the GDP growth rates and the potential GDP become more aligned. So that shows us that the global economy is well positioned despite the risks, notably geopolitical tensions, especially in the Middle East region. As you are aware, the conflict also in the Russia-Ukraine region that has really upset supply chains and also raised maritime shipping costs. That risk still remains. However, we can say the balance of risk is skewed or it's broadly balanced, unlike the past year where risks were very, very much against the global outlook. And what's even more interesting is that despite the elevated regime of interest rates we are in, global trade still remains resilient. Even economic activity has ticked up relatively on a global average scale. Secondly, I think we are seeing divergence at play in terms of global growth. As we pointed out earlier at the start of the year, we expected that growth would become increasingly divergent across and within regions. That I think has continued to play. And thirdly, we're seeing risks still remain, as I pointed out earlier. The geopolitical tensions continue to pile pressure on price levels. We are wary that these shocks may continue to bring about inflationary pressures over the medium term. However, at present, I think we're seeing inflation generally ease across the board. However, these last few quarters, we've seen inflation become more stubborn, uh, trending slower and slower towards the central bank targets. But I think it's a matter of time before inflation begins to tick up. So another thing we've also noticed is that countries on the path to fiscal consolidation, that is countries, especially in the emerging and frontier markets, such as where we sit, have been on the path of raising tax revenues and reducing recurrent spending. However, some of them have encountered headwinds, such as the need for relief spending, and also we are aware a huge number of emerging and even developed markets were due or have already conducted their general elections. Have elections which were done in the UK. We have even in more closer home, South Africa recently concluded the elections. Rwanda, nearer home, have completed the elections. And this also comes with increased government spending. So that has slowed down the path to fiscal consolidation. In terms of the growth prospects, I think growth is still expected to remain resilient, even going by the IMF estimates in the July World Economic Outlook. And this is supported by easing inflationary pressures. On the demand side, we're seeing increased or resilient public and private services spending, in the sense that consumers are now spending more on the back of the fact that inflationary pressures are not as intense as they were a year ago. On the supply side, I think the stabilizing price levels are continuing to support growth. Supply chains are also rewiring. We are seeing the globalization trends, and that bringing about the divergence we talked about. Demand is largely shifting from goods to services. However, we think the tide will swing, the pendulum will swing back the other side over the coming quarters. When you take stock of the major themes we highlighted at the start of the year, we expected politics to keep markets guessing. So the geopolitical tensions in the Middle East notwithstanding, we know that more countries, as I pointed out, are due for elections. We know the United States, for instance, is set for their general elections later this year. What we are wary of is that this may come with significant policy shifts. We may likely see an increase in unilateral trade restrictions coming into play, especially with US-China trade wars. That again it raises the inflation outlook coming back into the picture. We're seeing deglobalization in the form of US firms, for instance, relocating back away from Asia back into the US. That again raises the inflation outlook as retaliatory responses between the two powerhouses come into play. Secondly, we highlighted the prospect of the higher for even longer interest rates. Yes, in as much as we are starting to see some central bank policy divergence, that is, we're seeing banks such as the Bank of Canada, Switzerland, and more recently the European Central Bank who lowered interest rates. Other key markets like the US Fed have still maintained rates elevated. However, we think the general path of interest rates will be much slower in terms of the rate cuts. We think markets were expecting interest rates to come down sharply, but much to their chagrin, we are starting to see that because of the stubborn inflationary pressures, central banks are still keen on keeping rates higher to rein in the pressures. Thirdly, we expected widening divergence on performance across and within asset classes. On the equity side, we saw key markets like the US, for instance, equities markets were really resilient. Actually, robust is the right adjective. We saw some of them cross the new record highs, like the S&P 500, soared to record highs over the first half. And this was largely driven by tech disruptions and also the expectations that interest rates will decline and drove performance. Second, on the fixed income side, we noticed volatility coming into play, given markets were on edge. The expectations that interest rates would come down sharply this year. However, much to their surprise, it's becoming more and more clear that perhaps inflation will likely stay or will likely linger for longer, and as such, that explains the volatility in treasury instruments. Coming closer home, Sub-Saharan Africa, we noticed slowdown pressures continue to persist, if not for whether adverse climatic conditions, it has been due to either political instability or slowing consumer demand. However, we reckon or we take positive note of the fact that intra-regional trade has been growing, intracontinental trade has been accelerating, which is a positive sign and is likely to power growth over the remainder of the year. The growth outlook is net positive for the region. An average growth rate projected to rise to 3.7% this year, up from 3.4% last year. However, that is pegged on other risks, like how fast interest rates will come down to stimulate the much needed growth. That remains to be seen. Secondly, we saw mixed exchange rate trends across the region. The volatility persisted. For instance, the Kenya shilling, as we know, still retained its top position in as far as appreciation against, for instance, the US dollar, for instance. However, on the flip side, the Egyptian pound and even the Nigerian naira, those currencies were devalued, so they really they depreciated in the very strong double digits, 56 and 80% respectively, against the US dollar. And thirdly, we are still seeing shifting fortunes in international debt markets. We know, unlike in 2022 and 2023, where no African nation was able to access the international Eurobond market. However, that reversed this year. Countries like Ivory Coast, Benin, and Kenya were successful in raising finance via international markets at very low single digits or low double digit interest rates. So that's a good sign that the improving prospects for the region. However, the fair share of challenges remain. For instance, we're noticing most SSA governments are grappling with rising interest expense to tax collection ratios, which is an alarming sign in as far as debt sustainability is concerned. However, what gives the gleam of hope is that more nations are embracing fiscal consolidation, containing the growth in spending while putting in measures to promote tax revenue growth. Even at sometimes even if that has led to political unrest in some nations, like for instance where we are, we think that highlights the clash of the fiscal consolidation drive against the cost of living realities faced by the citizens. I'll now invite my colleague Stacey to take it home or proceed with the Kenya outlook. Welcome, Stacey.
Thank you, Ronnie. And as Ronnie has mentioned, I will take you through the Kenyan macro outlook, starting with the Kenyan economic growth. The Kenyan economy expanded by 5% over the first quarter of 2024, and this was a slower growth compared to the 5.5% that was recorded in the first quarter of 2023. This growth during the quarter was driven by resilient activity in the agricultural sector, which was supported by the favorable weather conditions. This growth was also supported by growth in the financial and insurance sectors, and it was weighed down by a contraction that we witnessed in the manufacturing and in the construction sectors. From the chart on your right, you can see that the forecasted GDP growth for 2024 is at 5%, and this is a downward revision from our earlier expectation of 5.6%. We revised down our expectations given that we expect a slowdown in the private sector credit demand, and we expect that this slowdown will lead to less investment in the economy, which will slow down the overall economic growth. Looking ahead into 2024, we expect that the services sector will remain the engine of growth, accounting for over 55% of GDP, as activity trails firmly above the pre-pandemic levels. We also remain hopeful that the increased investment inflows should lead to growth and expansion cycles across various sectors, which will support the overall GDP growth. And now let's have a look at the price levels. We witnessed price pressures easing further during the second quarter of the year, and this was signaled by the softening of headline inflation rate to 4.6% by June of 2024, which was 110 basis points lower compared to 5.7% as of March of 2024. If you have a look to the chart on your left, you can see that headline inflation has been progressively easing. And we now see that headline inflation stands at CBK's midpoint target of 5.5%. We also similarly witnessed a decline in food inflation, fuel inflation, and core inflation. We attribute the long-running disinflationary trend to lower food prices from increased staple food supplies and lower fuel costs due to the stronger shilling. And looking ahead into the second half of 2024, we anticipate that headline inflation will remain sticky and it will oscillate around the central bank's lower midpoint range of 5%. And our outlook on inflation is based on the expectation that consumers and business confidence will stabilize. And we also believe that the current tight monetary stance will continue to alleviate the inflationary pressures. And all that being said, we still see that the political uncertainty that we're currently seeing could hurt the business environment and also potentially increase inflationary pressures. And now let's have a look at the exchange rate. The Kenyan shilling remained resilient during the second quarter of 2024, strengthening further against the hard currencies such as the dollar, the sterling pound, and the euro. Key to this performance were the reforms implemented by the Central Bank of Kenya in the first quarter of 2024 to enhance operational efficiency in the interbank foreign exchange market. And just to mention, what one of the notable reforms was the introduction of a matching system, which allows the CBK to publish exchange rates based on an average of all the interbank transactions from the previous day, instead of relying on the indicative rates as was previously done. Looking ahead into the second half of the year, we maintain a stable outlook for the Kenyan shilling, and we expect continued stability, largely driven by a narrowing current account deficit. Additionally, we expect that dollar inflows from key export earning sectors such as agriculture and tourism to stabilize, and the growth in diaspora remittances to further support the resilience of the shilling that we have been witnessing so far this year. However, the rising external debt service commitments pose significant threats to the shilling's resilience. And now let's have a look at the foreign reserves. Kenya's stock of gross foreign reserves experienced a significant boost, reaching $7,800 million by the end of Q2 of 2024, which is enough to cover 4.1 months of import cover. Despite this high import cover, it still stands below East Africa's minimum requirement of 4.5 months. We attribute the one-off surge in reserves to the receipt of $1.2 billion from the World Bank's Development Policy Operation financing. And this operation has the objective of supporting our country's policy and institutional reforms. Looking ahead into the second half of 2024, we anticipate moderate net drawdowns in Kenya's capital buffers, keeping the reserves at or slightly below the required thresholds. And however, we still see that we will be gaining capital calls from our multilateral guarantors such as the IMF and the World Bank, and we expect that these capital calls will maintain the stability of our reserves. And now let's have a look at the fiscal performance. In the fiscal year of 2024, fiscal revenue collection fell slightly short of the revised targets and achieved a prorated performance of 93.1%. This shortfall led to a decrease in development spending, resulting in an absorption rate of only 69.7% of the supplementary 2 estimates, as you can see on the chart to your left. Meanwhile, we witnessed that recurrent spending and the equitable distribution to county governments both exceeded the 90% of the targets. So far this year, we've witnessed that the efforts to increase the effective tax to GDP ratio by the National Treasury through various tax hikes has faced backlash, which we have seen has led to the Maandamano protests and led to the broader anti-government demonstrations. And what we're seeing is that there's a call for accountability and for the responsible use of public funds. We've also seen that the proposed finance bill of 2024 and the proposed tax raises caused a lot of discontent, and following the president's decline to assent it into law, the National Treasury released a supplementary budget 1 for the fiscal year of 2025, where the expenditures have been trimmed and borrowing targets have been increased in line with the projected revenue shortfall, amounting to 346 billion shillings. The government reduced its expenditure target by 3.1%, translating to a decrease of 121.8 billion. And additionally, from this supplementary budget, we saw that net domestic financing targets were revised upwards from 1.5% to 1.6% of GDP, and that net external financing targets were also revised upwards from 1.8% to 2% of GDP. And finally, I will take you through the monetary policy. where during the second quarter, we've seen that the Central Bank of Kenya maintained the benchmark rate at 13%. And this was in a bid to further firmly anchor the long-term inflationary pressures and to stabilize the exchange rate pressures. We saw that in 2024 of May, that the CEO survey conducted by the CBK revealed that there were concerns about a potential resurgence in inflation, primarily due to the impact of the proposed tax measures in the now defunct Finance Bill 2024. Given that now we've seen that headline inflation at 4.6% is within the lower target range, and we've also witnessed that the private sector credit growth has been declining to lower digit numbers. We anticipate at least one cut in the benchmark rate before the end of the year. We expect the CBK to remain increasingly vigilant to prevent losing the gains secured so far in maintaining price stability. We also opine that keeping the interest rates high for this long could weaken the growth momentum that so far we have witnessed in 2024. And now I will hand over to Ronnie for the equities outlook.
Thank you, Stacey, for that amazing Kenya roundup. I'd like us to shift gears toward the equities market, looking at the forces shaping performance over the first half of 2024. So how can we describe the first half of the year? I think the equities market has been on a much stable footing this year compared to last year. However, towards the latter end of the second quarter, we started to see headwinds emerge, challenging the recovery momentum for the equities market overall. I think there are three major themes that we think shaped the sector. Firstly, we noticed a widespread migration to equities. So because of the elevated interest rates environment we're in over the past 3 years, we noticed capital flows were largely pivoted towards fixed income assets. However, that changed over the course of the year, where we started to see investment flows again coming back to the equities market. That, however, has been challenged by the fading hopes of interest rate cuts, which we expect will slow down the rate at which flows are streaming back into the equity space. However, we think because of the increased optimism as reflected by the key indices soaring to record highs, we think that reflects even greater optimism for markets overall, since we know equity markets are simply discounting mechanisms that price in future expectations. Secondly, we think we observed increased multi-sectoral divergences across and within sectors. We saw, for instance, the banking sector still keeping up with its unprecedented momentum. The telecommunication sector again emerged. Basically, service-oriented sectors stood out compared to their manufacturing counterparts, pointing still to the new regime we are in of higher volatility. And currently, we're also witnessing less tolerance among investors for weaker stocks, or let's say the non-performing stocks. We are witnessing increasing portfolio rebalancing activity as investors tilt away from sectors that are underperforming and take up the outperforming sector stocks. Thirdly, we noticed that large cap stocks continue to prove their worth. Over the first half, the equities index, that is the MSCI All Country Equities Index, recorded an 11.3% return, largely driven by bullish performance across tech-oriented stocks. However, when you compare against last year, it's a bit slower on an annualized basis, pointing or largely attributed to the slower than expected corporate performance. And as we pointed out, the fading hopes of interest rate cuts. Coming closer home, On a regional perspective, we noticed the African equities market overall continue on its resilient recovery path, delivering an average return of 10.8% in local currency units. The Nigerian market led the charge with a 33.8% return over the first half, followed by Zambia and Ghana with returns of 28.1 and 22.3% respectively. The Kenyan market wasn't left behind. It posted a return of 18.3% year to date, with the slowdown coming in at the latter end of quarter two. But the slowest market was Rwanda, which posted a very mild return of 1.3%. However, when we switch the scales to USD returns, Kenya was the best performing market year to date with a 44.3% return. While on the flip side, we had Egypt and Nigeria at the bottom with 28.1% return and negative 22.3% return respectively. That, of course, coming on the back of the currency devaluations that their respective central banks embarked on. Funneling to the Kenyan market, I think the Kenyan market, as you can see by the indicators there on the table, they're all pointing in the green, pointing again to the resilient recovery story for the NSE. Equity turnover was up by more than double year on year, growing by 225% to 46.9 billion over the first half of this year. Market capitalization has been up again 18.9% since the start of the year. And the same is also reflected in the Nairobi All-Share Index. We attribute this improved equities performance to increased domestic investor participation. Yes. Unlike prior years where performance was largely correlated with increased foreigner participation, this year we witnessed a scenario where market indicators were improving, even with declined foreigner participation. As you can see, foreigner participation declined to 39%. However, we similarly notice that despite that decline in percentage terms, their sentiment also reversed firmly into positive territory for the first time in over 10 quarters. So you can see over the first half of 2024, foreign investors recorded net inflows or a net buying position of about 2.98 billion Kenya shillings. Of course, a reversal from 1.44 billion of outflows for a similar period last year. And when you look also at the market price to earnings ratio, which is a measure of the forward expectations by investors, you can see that it's also rising from 6.2 last year to 8.5 at the start of the year and closing the first half of this year at 10.2x, which we believe points to greater optimism for the equities market. We are seeing earnings per share or corporate earnings becoming more correlated with higher capital gains and even higher dividend yields. So that's also contributing to the improved sentiment. And we think the NSE has been on a firm footing. However, towards the latter end of the second quarter, we started to see slowdown pressures, largely driven by the political unrest that emerged towards the end of June. Trading activity slowed down somewhat, of course, due to the anti-government protests that have been going on. Until a lasting solution to this is firmly in check, we expect flows to the region to slow down somewhat. However, we don't think that will be enough to decimate the momentum that has built up over the year. We are still net bullish for the Kenyan equities market overall. If you look at the top traded stocks over the first half of 2024, we have there Safaricom leading the charts with over 14.1 billion in total turnover over the period. That's about $109 million. Of this, 66.2% of the turnover was contributed by foreign investors who are largely on a net selling position on average. However, as per the closing price at the end of the first half, that represented a 27.7% gain, pointing to the decent recovery across blue chips. That the same was true actually for most of the top 14 stocks were all up year to date, with the exception of BK Group. But coming closer home to the top movers, in second place, we had Equity Group with just about 9.45 billion in total turnover, over which 75% of that was contributed by foreign investors. I&M came in that, of course, on the back of a one-off block trade, with Africa Invest acquiring 10% of I&M. So that's why I&M shot up to that place. KCB Group took fourth with just about 6 billion in total turnover. And you notice with KCB, the majority or the dominant investors in KCB were local or domestic institutional investors. And we saw some decent recovery in KCB, gaining 37.2% on a year-to-date basis. In fifth place, we had East African Breweries with 1.5 billion in total turnover, largely dominated by foreign investors. But yet again, on a first half basis, the valuations were up 14.5%. So that points to the recovery story of the NSE, which erases the many consecutive quarters of underperformance. We expect this momentum to hold up, especially for blue chips, now that we are at a turning point of the business cycle. We expect blue chips to feature more or reprice optimism even more strongly by the end of the year. When you look at foreign participation at closer level, we notice foreigners were largely net buyers of KCB Group, East African Breweries, Equity Group, largely banking stocks, and of course the exception of Kenya Power there and Jubilee. But of the top five, we have three banking stocks. On the flip side, foreigners were net sellers of Safaricom, British American Tobacco, Kengen, Stanbic, and Bamburi over the first half of 2024. Yet we think that is largely it's largely within historical trends. I think a first half of the year is too narrow a time frame to conclusively judge overall sentiment. Perhaps on a year-on-year basis, that by the end of the year, we'll get the farmer barometer of sentiment by foreign investors. When you look at the winners and losers in terms of capital gains, leading the charts was KCB Group with a 42.4% gain to close the first half at 31.25, followed by Liberty Kenya with a 37.3 gain since the start of the year. And in that place, we had East African Breweries recording a 26.2% upside. Followed by that, we had Safaricom with a 25.8% gain. And in fifth place, we had Equity Group with a 23.5% gain. And what's more interesting is that, as I pointed out in our thematics, the legacy blue chips, the blue chip counters that we usually are tracking on a monthly basis emerged more prominently, and like the penny stocks that you will usually dominate the top 10 list. Interestingly, for this first half, we have a mix of actually all blue chips, major blue chips featuring on the top gainers list, pointing to the strong recovery of the NSE, and we expect this momentum to keep up until at the end of the year. On the flip side, we had East African Portland Cement with a loss of 37.6%, followed by Unga Group, 25.5%, and Kenya Reinsurance with a 23.2% decline. On the dividend list, on a trailing, actually this is not on a trailing, but on actual closing prices at the end of the financial years, respective financial years. We see Umeme still leading the charts with a 19.4% dividend yield, or computed on ex-div prices. Standard Chartered came in second with an 17.9% dividend yield, and in that place, Kengen with a 14.9% dividend yield. In fourth place, I&M Holdings with a dividend yield of 14.6%, and Williamson T came in fifth with a dividend yield of 14.4%. Overall, dividend yields were rising, and we think that contributed immensely to the optimistic expectations that are being priced in by investors, increased investor participation levels have come up to the surface, reinforced by the discounted valuations on blue chips that were now reversing, as you can see in the top gainers list I showed in the previous slide. Now I'd like to shift gears to the fixed income outlook, pointing out the key themes that have shaped the sector. The first thing we think has shaped the fixed income market, we saw yields take on a different turn. We saw interest rates peak towards the start of the year. Then towards the end of quarter one, we started to see a reversal in the direction of yields with a leaning towards a cautious easing. That is to say, yields, yes, in as much as they are declining very, very gradually. We attribute that to the improved fiscal confidence after the refinancing of the 2024 Eurobond that also preluded the strengthening of the Kenya shilling. That we think led investors to lower the risk premium when bidding for treasury papers. However, that also has not been without its fair share of challenges. More recently, with an adverse credit rating, that also has challenged the pace of the decline in yields. Secondly, we saw the central bank continue on its drive to nudge yields lower, especially on the short end of the curve. T-bills, at least they are back to where they were a year ago, containing the surge that they had displayed last year. We now started to see the central bank issue more long-term bonds, unlike last year where they were only issuing short duration bonds to contain the higher for longer interest rates pricing only for a shorter duration. As a result, we saw the yield curve invert, and it still remains inverted, as you shall see in the coming slide. And then thirdly, we saw secondary market trading activity still hold up 156% year on year to 458 billion. And that, of course, being driven by increased demand for infrastructure bonds. If we look at the statistics overall, on a half-year basis, NSE bond turnover was up 402% over the first 6 months of this year to 767 billion compared to 152 billion a year ago. Looking at the bond index, which is a measure of the bond prices, benchmark bond prices, you notice it was up 3.7%. And that was attributed largely by a decline in benchmark yields. If you look at the 2-year, 5-year, 10-year, 15 and 20-year yields, they are all starting to come down, more prominently on the 5-year domestic yield. That is driving the increased bullish trends in benchmark bonds. Even the reinvestment yield, that is the coupon rates that the CBK has been offering, have been on the rise on average to the high teens. And we expect this rally to persist, albeit at a slower pace. As we know, as my colleague has highlighted, the government has revised its net borrowing target upward. So we expect that to slow down the pace at which yields were declining, or rather the higher for even longer regime that we are talking about. Yet, all the same, we don't expect so much volatility in the yield curve. We only expect some disturbance or some volatility on the short end of the curve. We're seeing the central bank begin to nudge yields lower. Actually, if you look at the yield curve at the start of the year, which is the line in black, and the line in orange, which is the yield curve as of the end of June 2024, you can see the yield curve has been cooling off. However, it's been a bit stubborn on the 91-day rates, 182 to the 1-year rates. And even when you look at all the way to the four-year yield, 3-4-year yields, they've been particularly stubborn at that point. And we expect to remain that way over the next 6 months. However, on the long-term end, yields began to decline. And we expect only but a marginal downward shift with periodic disturbance, depending, of course, on the duration of oncoming treasury bond issues. Great. And now we'd like to top it off with portfolio management investment implications based on the themes we've highlighted in the presentation. What are the investment implications as we head into the final half of the year? Firstly, we continue to stress selectivity in investments. That is, in as much as we encourage investors to diversify, we urge them to be selectively diversified. This is because we are in a new regime of higher volatility across and within asset classes. So to the extent we are able to identify outperforming sectors and counters, to that extent will be better rewarded by the end of the year. Secondly, we think investors will need to be more dynamic in how they rebalance their portfolios, meaning the typical buy and hold strategy may not work for us in this new regime. Investors will need to be willing to tilt their portfolios, that is to say, reduce holdings of underperforming counters while increasing holdings of overperforming sectors as the business cycle evolves. And thirdly, we think investors will still need to more shake off the recency bias, which is the bias to think that what happened in the past will hold. In this new regime, actually, that has been more and more challenged, which is why we think investors will need to embrace hedging strategies, including derivatives, to mitigate and hedge risk exposure. And to that, if you grab a copy of our Q3 report, we have a suite of equities recommendations for the third quarter. We are bullish on select stocks in the banking sector, manufacturing, and telecommunications. And we even give expected returns as signified by our 1-year target prices and the weight we recommend for each counter. Over the first 6 months, portfolio recommendation has been competing fairly well against the NSE 20 benchmark. And we think it's more in line now to build portfolios towards the banking sector, which continues to increasing profitability levels. We have KCB Group, Equity Group, Standard Chartered, NCBA, and Stanbic Bank Kenya, which if we take even a look at our monthly stock recommendations, we highlight the reasons behind or the strengths we are looking at, as well as the risks for each counter. We'll share the links to that in the description or in the chat. We have EABL and BAT from the manufacturing. Yes, we have their latest earnings of the latest financial years. However, yes, in as much as we're noticing pressures emerging for East African breweries and BAT, especially on the net earnings side, we are positive over the next 1 year horizon. We anticipate decent recovery in consumer spending, and our inflation outlook also remains conservative. So that we expect will lead to easing cost pressures and at the same time recovering top lines, which should help lift overall profitability levels and consequently the ability of funds to raise their progressive dividend ratios. And lastly, we are still net optimistic on Safaricom. I think it's largely discounted given the optimistic prospects that are in the near horizon, which is also reflected in our weighting. We are particularly interested in KCB as well, as signified by the weighting we are giving of 22%. Largely, we think, given the moves management has taken to restructure capital buffers and to the extent even of withholding dividends in the last fiscal year, points to the priority of management of putting the business on a healthy footing against pleasing or short-term pleasing investors in the form of dividend, rewarding investors in the form of a dividend. And if you look at their proposed sale of National Bank of Kenya, which is still in the pipeline, we expect it to be consummated by the end of the year, and that again should free up the locked-up capital in terms of the provisions they need to make for the non-performing loans ailing the National Bank of Kenya. So we think it's very, very largely underpriced, and we think it's set for a better recovery over the next 6 months to 1 year horizon. We also have a suite of fixed income recommendations that I believe you will find interesting. Thank you very much, and I'd like to hand over to Sheila to lead us in the Q&A session. Thank you so much for your indulgence.
Thank you very much, Rooney and Stacy, for the comprehensive overview of the macro books and the valuable guidance on the investment strategies for the remaining quarter of the year. Now I take this opportunity. We'll transition to our Q&A session. Please feel free to write down your questions in the chat and we'll address them accordingly. So we take the first question is, the appreciation of Kenya shillings to USD dollar in H1, what were the drivers of this, given that this isn't holding as much and it's on a fall at this time? What is the projection of Kenya shillings to USD rate at the year end?
All right, so maybe I can take on that part one. So in terms of our, first of all, the drivers of the strengthening of the Kenya shilling over the first half, we know the Kenya shilling strengthened about 17.1% against the US dollar. This came in decisively in February this year, and it came first on the back of the government's move to refinance the 2024 Euro bond, which was very successful in as far as the subscription rate. It was oversubscribed. That also coincided at a time when the government had floated an infrastructure bond at a multi-decade high coupon rate of about well over 18%. So the consequence of that is that we had increased portfolio inflows, especially from foreign investors, which of course strengthened our balance of payments position. So that in itself, coupled more strongly with the successful refinancing of the Eurobond, really recast the risk sentiment, which was what was driving the depreciation in the first place. It wasn't necessarily as a function of a worsening of our external position, as it was of an overpricing of risk sentiment from where we see it. In as far as our projection of the KES USD by the year end, we have outlined that we expect the Kenya shilling to remain resilient or stationary is the word we've actually used, sustained stationarity. That's a term in time series analysis, meaning we don't expect aggressive volatility like we saw last year. We expect it to be largely plus or minus 5 points from where it is, and largely because of the strategy that the central bank employed to reform the interbank foreign exchange market. Like, for instance, as my colleague alluded, the transition from a reporting of exchange rates based on indicative rates to a reporting framework based on the actual trades in the interbank market. So that in itself has really transformed the foreign exchange market, and that's why we don't expect even momentary political unrests to disrupt the exchange rate outlook, as it were.
All right. Thank you so much, Rooney, for that. Next question. Now that Moody's has downgraded Cooperative Bank, KCB, and Equity Bank, is it time to sell holdings in these shares? Are we expecting these shares to go down significantly in price?
Abigail, to answer your question directly, the decision by Moody's to downgrade Cooperative, KCB, and Equity Bank, in our view, isn't necessarily reflective of the credit risk profile of the companies, as much as it's an adjustment to what the sovereign rating reflects, given the exposure that all these banks have. We are not particularly alarmed by the credit risk, as it was from our position. We think the credit position remains, or rather, the broader sovereign risk profile remains fairly stable, fairly insulated. Tax revenues are growing in double digits. At the same time, the encouraging sign is that we're seeing the government slow down the pedals of recurrent spending. So that should increase the buffers we have to accommodate even a higher public debt to GDP ratio. So we expect these holdings relatively to hold up, nevertheless, the credit rating notwithstanding.
Thank you, Rooney. I hope it's clear. To Abigail. On to the next question. Given the fact that the finance bill has been revised, Kenyan inflation has been falling, and the recent announcement from the Fed chair indicating that they will not wait for inflation to reach 2% to cut rates, what is your take on the wait and see approach that has mainly shaped central bank decisions such as the CBK, and what will that look like as far as rate cuts are concerned?
Well, what we're seeing right now is that the economic environment seems to be creating a room for potential rate cuts. We see that the CBK's wait and approach that they've been using and that they're still currently following, it suggests that they're likely to keep on moving more cautiously, and they're likely to keep on prioritizing economic stability and sustainable growth as they have been, instead of prioritizing quick policy changes. And that being said, we see that the CBK will probably wait for clear, consistent signals from both the local market and from the international market, and they'll study the economic indicators as well before initiating any rate cutting cycle. And we believe that this will most likely come in the latter half of the year, so around Q4, the latter end of Q4.
Thank you, Stacey. Next question. Can Kenya sustain deficit without passing another finance bill? Without a finance bill, when the shilling spiral out of control during the upcoming principal payments, do you think major stocks like Safaricom will go up if a bill is passed?
So to answer the question, whether Kenya can sustain the deficit without passing another finance bill, is that sustaining the current deficit without passing a finance bill will be challenging and will also potentially be risky for the financial health of the country. Historically, we've seen that Kenya has been running on budget deficits, and this means basically that the government's expenditures have been exceeding the revenues. And so, without passing another finance bill, the government will have to then take on measures such as strict expenditure controls and also effective debt management. And it will also possibly mean that they will have to look for further international support from guarantors like the IMF and the World Bank.
Just to add on for context on what Stacey has said, certainly the puzzle of sustaining a budget deficit is not an easy one. You can only reduce government spending so far. Before now, we start to see a deterioration in delivery of public services. Fortunately, we've seen, for instance, in the supplementary budget one, that it's possible to cut recurrent spending or the government largesse in some sectors. However, if we are to follow this question to its logical conclusion, sustaining a deficit without another finance bill would imply a reduction in development spending to the minimum. It would also imply a reduction in social welfare payments and transfer payments, like for instance, to pension payments, for instance. Those would likely be first on the table for cuts. But again, we can only reduce spending so far. Ultimately, at some point, you have to raise tax revenues, even be it in the form of another finance bill, or rather increased appropriations in aid. It's not necessary. It's not mandatory that you raise tax rates to realize an increased tax basket overall. Ultimately, a broader tax base can just as well increase your overall tax revenues, even without increasing the rates, the tax rates, effective tax rates. In as far as the last question, you stock movements, like for instance, Safaricom correlate with, let's say, the finance bill. I would say the correlation might be there, but a very weak one or a moderate one. I don't think there's a direct impact between or direct correlation between government passing a finance bill and, let's say, any adverse or bullish movement in a stock. Maybe only in as far as it shapes sentiment on fiscal sustainability, which could then lead to either an adverse outlook on the investment space. But the correlation is very, very distant. I can't find a thread to link it to that.
All right, thank you so much, Rini and Stacy. I hope the answer was clear. The other question is, kindly explain the weighting in slide 29. Assuming KCB weight is 10%, how does the target price change?
Okay, so in our stock recommendations, well, the weighting does not affect the expected return, but it responds to the expected return. So the higher the expected return, the more weighting we are likely to give to that counter. Our target price is a function of it's derived by our discounted expectations. That is to say, our forecast for key line items, key revenue line items, and as well as expenditure items, which we then discount and estimate a fair value for. Our target prices, it's good to note, they are dynamic. As we get relevant information, whenever we get new information, we feed it into our models to reevaluate what new target price or forward price we anticipate for a particular stock. So even if we reduced our exposure to KCB to 10%, that wouldn't affect our target price for over the next 6 months to 1 year.
All right, thank you. kindly mention about the dividend stocks for the 1-year horizon.
Okay, I think we had a slide on the dividend yields, and it's also in our Q3 report. Those dividend yields were computed on ex-dividend prices, and we expect them to remain that way this year. Of course, with the allowance of without, of course, a change in our assumptions, we expect the banking sector to still lead the charts on average in as far as dividend yield is concerned. More markedly, we notice Standard Chartered distinguished itself among the banking sector peers. We know Umeme Group's moratorium is expiring in 2025, so this counter may not be available for the next 1 year or more. So the next best alternatives now we have are from Standard Chartered. Kengen, of course, we expect their performance to sustain for the remainder of the year. So we expect them to still sustain or even increase their dividend yield in 2024. Followed also by I&M, which has been really on an operational efficiency momentum, containing growth in OPEX before loan loss provisions, while at the same time pricing in momentum on the interest income from loans and advances. So that should, in our view, help them even build their capacity to even raise the dividend yield even higher. We're noticing their ROE, in as much as it's still lagging behind the peers, we expect it to build up towards the stronger double digits next year. But you can find this and more in our Q3 outlook.
Thank you, Rooney. Unsure, but I think you stated that the NSE went up 2% YTD, but the equity slide seems to have an average of more than 10% price increases. Could you just clarify this?
Yeah, so with this slide, I was comparing the market capitalization since the start of the year. So our market capitalization was at 1.44 trillion at the end of December 2023. And at the end of June 2024, it was at 1.7 trillion. So comparing half on half, that is from end of December to end of June, that was an 18.9% gain. But when you compare June 2024 versus June 2023, that's a gain of 2.7%. So indeed, it shows you that the NSE was on a valley of disappointment, with the market cap dropping from 1.67 trillion to 1.4 trillion, but again recovered strongly to 1.7 trillion. The same is reflected in the index. Up from 1.107, dropped to 92 by December, then recovered to 109 by June this year. Those are the half on half and then the year-on-year percentages. I hope that is clear.
Yes, thank you so much. When buying shares, what guides your price? Is it the last price trading or the margin given so as to get a good price when buying?
Yeah, so I think if I get you well, I don't know what particularly you mean by margin given, but when you're buying shares, you want to look at the market depth, which is you want to see what's the volume of bids in the market, as well as the supply, which is the ask, the volume of supply will, and also the supply levels. You have the supply prices, beg your pardon. You would see, let's say, the best bid, let's say for counter, if let's say it's Safaricom closing, which closed today's trading at about 15.3, I mean at 16 shillings rather. If the best bid is at 15.90 and the best offer we have is at 15.10, that can give you a guidance as to where you can place your limit order. Maybe somewhere in the middle, or even if you wanna really lock in the demand that time, you can quote the price as of the best offer on the trading board reflects.
All right, thank you so much, Rooney, for that. Second last question: how will depreciation of Ethiopia currency affect Safaricom revenue from Ethiopia?
I believe what we've been seeing in Ethiopia is that the country for some years now has been struggling uh, with with chronic foreign currency shortages, and under this new devaluation, we've seen that the value of the birr will be set by the market.
I think broadly, Safaricom, because it doesn't charge its customers in US dollars, it charges primarily in Ethiopian birr, which is a local currency. So when it comes to the point of conversion for purposes of accounting, of course, they'll have to recognize the respective FX losses because it will also have depreciated relative to the Kenya shilling. So net, expect revenues or projected revenues to depreciate, or the organic revenues to actually decline by the same proportion of the depreciation. So yes, it will affect the books, although accounting requires you recognize foreign exchange losses on the profit and loss statement.
All right, thank you so much, Rooney and Stacy. One last question: when trying to choose between high coupon rates, short duration, and mid to low coupon rates and longer term, what should one take into account? What is the best way to optimize this? Also, please take us a bit more on the last slide on fixed income recommendations.
When it comes to building a fixed income portfolio, I think there are a number of considerations you need to make. Of course, the duration can vary based on your time horizon or an investor's time horizon. But net, we think looking at the present status quo, we think the time is ripe to lock in the attractive yields or the attractive income bonds you're seeing on chart before they become somewhat too expensive to purchase. We think because now we expect interest rates to decline, that implies bond prices will start to increase. So we think it's a good time to position bond portfolios to take advantage of this bond price rally. On to your second question, please talk more on the last fixed income. Actually, I've just used the slide to explain it. Maybe I can explain more is this modified duration, which gives you the sensitivity of the bond's price to changes in interest rates. For instance, this means the 4.3 here means if interest rates were to decline by 1%, the bond's price will rise by 4.3%, and vice versa is true. If interest rates rise by 1%, the bond's price will decline by 4.3%. I think all the other aspects I've explained. Tenor to maturity is simply the time the bond has to maturity.
All right. Thank you very much, Rooney and Stacy, and thank you all for your participation. We've reached to the end of our Q&A session, and if you have any further questions, please send them to our email. I'll write it down on the chat. Thank you very much. Over to you, Rooney.
Yeah, thank you so much, everyone, our distinguished clients, and even our guests, if you are listening for the first time. We thank you for indulging with us for the past 1.5 hours. We've had a very engaging session together. We are looking forward to hosting you in our Q4 outlook. And if you haven't read the Q3 outlook, we really encourage you to look at. We've only scratched the surface in as far as the macro implications and even our recommendations. We also have other publications on top of this. We have our monthly stock recommendations, which we update on at the start of every month. We revised our target prices every month to give you on the go recommendations which are in tune with the market developments as they happen. If you're not in our WhatsApp groups, you can, and you'd like to be added to that, you can send an email to us at research@aibaccessafrica.com, which is typed in chat. Thank you, Naila. If you have any query, feel free to reach out to us. If you have any trading related inquiry, let's say regarding DigiTrader, any queries regarding blocked accounts, you can send your ID to feedback@AIB or info@AIBAccessAfrica.com for assistance and account unblocking. Other than that, it's been a delightful evening. Thank you so much and have a wonderful rest of the week.
Thank you so much, Stacey, Ronnie. That was a very, as Daniel has said, eye-opening webinar. Great tips for investment. We learned a lot. I also learned quite a few things and looking forward to the next one. All right, everyone, that's the end. Please do reach out in research@aibaccessafrica.com, or if it's about your account, feedback@aibaccessafrica.com, and have a lovely evening.